Okay, ladies and gentlemen, welcome to Macro Ace with your host Tony. We're going to be going through US consumer spending and what that means for the markets and how to prepare yourself for the release. Hopefully, everybody can hear me clearly. If you can't hear me clearly, or if there's anything wrong with the stream, or if the screen isn't clear, do let me know. So we do have a lot to go through, so let's make a start with it. So US consumer spending, what is it? It shows how much consumers are spending on goods and services. And the key thing to remember is the PC price index that we get monthly data. There's a difference between CPI data and PC price index, or the personal consumption expenditure price index data that we get. The key thing that we've got to remember is that the PC price index includes prices in rural areas, as well as those paid by organizations that spend on behalf of households. So you're thinking of if you think of health insurance as one example that businesses spend on their employees, that is also included within the PC price index. Whereas the CPI data measures a fixed basket of goods and services, which over 2 years. So let's say, for example, if the price of beef is really expensive and consumers are buying chicken meat instead because it's cheaper, the CPI price index will keep the price of beef measurement in their report and include that within the food and energy part of the report. Whereas in the PC price index, what it can do is more malleable, so it can change what it measures. So it will instead give you more of a real sense as to where consumer spending is. And that's why the Federal Reserve looks at the PC price index as their key measure of inflation and where it is. Of course, they do take into consideration where CPI or the CPI price index comes into, but PC price index is the key measure for the Federal Reserve. So that's why when we're talking about the importance and looking at the data with the personal spending, which makes up quite a huge chunk of GDP, or about 1/3 of, if we're thinking about figures, can make up quite a big chunk of GDP and the economy. That's why it's seen as quite an important monthly release when we get the data, and also for economists too. So how does it affect the market? So when there's a healthy increase in personal incomes and spending, it bodes well for the US dollar. A high consumer demand usually encourages more growth and puts upward pressure on interest rates. And we've seen that in the past when consumer spending has been quite high, being matched up with inflation, picking up as well from the increase in demand for goods and services, with people coming back into people using some of their money saved up during the COVID pandemic with the stimulus checks that they had, and also being able to get a job to be able to spend more money than they would have done during towards the beginning of the COVID pandemic and the restrictions. So for the currency, the central bank, if they see that the economy is overheating and inflationary pressures are strong, and consumer spending helps to add to that, then it will likely lead to the central bank taking tighter monetary policy, or via higher rate hikes, or increasing the amount of rate hikes that they do within a given time. And then for stocks, so usually in a normal trading environment when sentiment isn't affecting the markets so much, and the interest rates in the US, or particularly in the US, has more or less reached neutral, and the Federal Reserve starts to ease off its tightening cycle. When consumer spending is strong, usually that bodes well for stocks, because that would usually fuel more economic activity and increase corporate profits, right? But in this current environment, what we have seen in the past occasionally with the US consumer spending report, is that when consumer spending has been strong during or at the beginning of a tightening cycle, we have seen some depreciation in the stock market in anticipation that the Federal Reserve will take stronger action to rein in that to rein in that inflationary pressure and the amount of growth or exponential growth that the US could see. And then with the bonds, so for bond prices, if we're focusing on that, any data that affirms sluggishness within the economy, it's expected to support higher bond prices and lower yields. Again, that's when we're not within a tightening cycle, when the economy is more or less in its expansionary phase, and the Fed has eased off the brakes a little bit, or has eased off the brakes altogether, and has decided to leave their monetary policy as it is, and haven't taken any further hawkish reaction or to try and rein in growth within the US economy. So for bond prices, usually you see if the economy is shown to start to go into a downward trend, and if you've seen some of the other webinars that I've done, is that the price of the bond usually appreciates. But in this current environment, what we've seen recently with the tightening cycle that we're currently experiencing within the US and globally as well with other central banks, that when with consumer spending, when it is high or much higher than expected, usually bond prices, what happens is with bond prices, we have seen them see a move towards the downside in favor of a higher yield. So that's one thing we've got to remember, is that when bond prices are low, the yield is higher, okay, and then vice versa to control supply and demand. And again, when rates are increased, the value of the currency, as said, usually increases, and in turn, the short-term rates, where the Federal Reserve has a lot of play and control of, when the interest rate is raised, or the federal funds target is raised, that will lead to yields also seeing an increase in appreciation too. So in that regard, you'd see lower bond prices, and we will go through the deviations that we'd seen last time to kind of prove that point there. Okay. So the previous report in March, the March report that we had seen. So U.S. inflation adjusted consumer spending rose in March despite intense price pressures, indicating households still have solid appetites and the wherewithal for shopping. So even as consumer prices continue to grow the fastest rate in decades, demand is strong enough to outpace inflation. A tight labor market and excess savings accumulated during the pandemic, as I said earlier on, have helped Americans spend despite inflation eroding wage growth and driving up the cost of living. Okay, so a reminder that when we're looking at the average, we'll go through where the economy is at the moment, but just to note on that point there, with average earnings in the US, so currently at 5.5%, which was lower than the prior figure, and of course inflation at 8.3%, still at a 40-year high, below from the prior monthly reading that we had. So even as consumer spending did see a pickup last month, where we had seen a rise to 0.9% from 0.5 from the prior figure, inflation hasn't really hampered that growth that much. So consumers are still willing to spend money. And then going further on, so in March, inflation adjusted spending on goods fell by 0.5% in the prior month, while services rose 0.6%, matching the biggest gain since July. So economists have been expecting demand for merchandise to wane as COVID fears subside and more Americans spend on travel, entertainment, and other services. Because that's also the key thing with any sort of recessionary situation that an economy is put in, is that a lot of the time, what we've seen during the COVID pandemic, is that consumers will look to spend on goods or necessities, and more or less be in favor, will go to those consumer staples like Walmart, Costco, or to their medical, or buying medical goods to try and survive during a recessionary period. And then when things start to ease and the economy is back on the mend and rates are starting to rise again, in to try and slow down growth or try to keep it try to keep the pressure um, under control, then what we usually see and what we've seen recently as well, that consumers start to go to look in favor of luxury goods or services that they don't really that are not necessities instead. So again, consumer spending has been quite strong in that regard. That services has seen a pickup, and I think that's another thing that we'll be keeping an eye out for, is how strong is the services side in the consumer spending report that we get later on, not too long later at 8:30. Also, you have the personal saving rate that dropped to 6.2%, which is the lowest since 2013. Now, remember, during the COVID pandemic, there wasn't a lot of spending happening. So a lot of the time, most consumers were saving as much as they could, of course, to try and protect themselves from, from a loss of income. But as the savings rate starts to decline, what that indicates is that, again, consumers are quite strong and they're quite resilient. So that being the lowest since 2013, again, shows that the consumer spending report that we had seen last time, the personal savings rate, was quite strong. Okay, and the markets reacted, and then we'll go through the market reactions and how that had fared in the 29th of April report that we had seen. So, where is the economy at the moment? So we have inflation at a 40-year high at 8.3% versus the prior of 8.5%. So a slowdown in inflation, not by a huge amount, and inflation is still quite strong and above expectations. And also for the PC price index year on year and the core PC price index year on year, which is what the Federal Reserve looks at, well above the Federal Reserve's target of 2% for inflation. So you have PC price index at 6.6 versus a prior of 6.3%. The core PC price index year on year at 5.2% with a prior of 5.3%. And then if we're looking at jobs as well, so that's quite a key thing when we're considering the job market. The more jobs that are added, okay, then there is a potential for more employees and more workers coming back into the labor force. And in turn, when there are more jobs added, that can lead to more spending from consumers if they have an income to spend on goods and services. And in turn, that can lead to inflation rates picking up. And then the final or the top tier level of the economy is where the Federal Reserve takes or steps in, as we have seen in the past. With the last couple of rate decisions that we've had, stepping in to rein in that inflation and start to raise rates or tighten monetary policy. So non-farm payrolls were slightly lower than the prior figure, than the prior release. It was at 428k versus 431k. Retail sales, again, a key measure of consumer spending, that had increased to 0.9% from a prior of 0.5%. And then consumer credit at 52.4 billion versus prior 41.8 billion. So again, as a reminder, if consumer spending is quite strong and people are taking more loans out, then that's quite good for the economy. So, of course, so just to also bear in mind as well, then with the consumer spending report, just a slight correction from what I said earlier. So a consumer spending report, as said, did increase from the prior 0.2% to 1.1%. The forecast for that was 0.6%, so it came in about 0.5% higher than the forecast. But yeah, just a reminder, consumer spending month to month. The prior was the actual was 1.1%, the prior being 0.2%. So if we're looking, just to go back to some of the other bits of data too, so unemployment rate was also unchanged at 3.6%. Q1 GDP, the advanced GDP unexpectedly fell to minus 1.4% from a prior of 6.9%. The forecast for that was 1%, and the dollar stocks didn't like that. Of course, that was a huge shock of seeing negative growth after the Federal Reserve had raised rates, and then there was another shock too. There's the stock market, as well as the dollar. That maybe the first quarter GDP, although it was supposedly supposed to see a slight decline from about 1.3%, it was even worse than expected. So the dollar and stocks didn't like that and didn't see a positive reaction in the markets. And the second estimate GDP data that we'd seen yesterday came in at minus 1.5%. The forecast was minus 1.3%. So it was much worse than expected. We didn't really see too much of a market reaction from that yesterday. Again, so the second estimate didn't really do much. But still, for an economic standpoint of view, now we're waiting for the final estimate, or the third estimate from the BEA. Then we'll again see whether or not the final data does show that contraction is either worse, or whether or not it's more or less in line with minus 1.5%. Okay, so triggers then. So according to economists, so they see a trigger with a high estimate, so the actual figure where they see it coming out as the high estimate of 1.2% with a low estimate of 0.5%. Personal income with a high estimate of 0.8% with a low of 0.3%. Then the PC price index month-to-month forecast with a high estimate of 1.4% with a prior of 0.1 with a low of 0.1%. PC price index year-on-year, high estimate of 6.3% with a low of 6.1%. Core PCE price index, high estimate of 0.7% with a low of 0.2%. And then the core PC price index year-on-year with a high estimate of 5.1% and a low of 4.7%. So if we're looking at the data today, then the median forecast that we see, so consumer spending month-to-month is expected to see a decline to 0.8% from a prior of 1.1%. So the economists are looking for about a 0.4 deviation from the forecast figure with the actual figure. Personal income with a median estimate of 0.5% unchanged from the prior, but economists looking for a 0.3% deviation either way for the personal income data. And then the PC price index data that we want to be aware of too, which is going to be quite important when we're looking at inflationary pressures. So PC price index month on month, seeing a median estimate of 0.2% with a prior of 0.9%. So the PC price index looking for about 1.2% deviation on there. And then with the low estimate about 0.1 according to economists. So they're expecting inflation to more or less remain stable and not see too much of a decline if we're comparing the high estimate and low estimate. But if we do get really high, really strong data, then they're looking for that 1.2% deviation there. The core PC price index as well, another key measure, so looking for 0.2 deviation at 5.1% with a median estimate of 4.9% with a prior of 5.2%. So that's what we need to just be aware of then, as the median forecast that we see for the PC price index, and also the consumer spending report that we'll get as well. Then going on then, so then the market, so Friday, the S&P fell into bear territory, or bear market territories, and it slipped more than 20% from its record high overall, right, as its a cumulative sixth weekly loss, right? That's how much the S&P had seen a move down by. But overall, so far at the moment, we can see that it's up by 0.2%. We'd seen that huge, big old reversal yesterday, where midday in the trading session, we were up about a percent on the day on the S&P 500. So again, just to note as to where we are at the moment in the markets and what we had seen last Friday, and according to economists, only one bear market in the last 50 years was not accompanied by a recession, and that was 1987. So I want to show you a little chart here of the S&P bear market since 1946. So majority of the time, when there has been a bear market for the S&P 500, that's been accompanied by a recession. Okay, and there's on average we've seen about a 32.5 or 32.7% decline in the bear market since 1946 as the average decline when there's been a recession or an onset of a recession. So here recently we're around just above minus 30%. That's what we've seen between 2020 and then between 2007 2009 we were well over we had seen about moreover about a 55% decline overall in the S&P 500. But from so far what we can see today as well, and including start of this week too, we've seen that reversal of that initial move towards the downside, currently up on the day, as said, by about now 0.3%. But if we're looking overall at the S&P 500 and the movement, if I bring it up on an hourly chart, so if we're going from the first rate hike decision, so from there, around on the 16th, so 16th of March when we had the first rate hike decision, then the S&P 500 did see a bit of a clawback. But then when stronger rate hike expectations were being priced in, then we'd seen this big old depreciation in the S&P 500. So again, can this really hold? Will this hold up today, and will this hold up for next week? Well, that depends on how strong this, or the overall downward pressure that we've seen on the S&P 500. And I think for trading wise, if we're thinking about today as well, movements aren't that strong at the moment. We're not seeing too many drastic movements occurring on the S&P 500. So could that mean that we do see a more of a normal reaction from the release to today than we may have seen in the past? We'll kind of go through that in a bit more detail with the deviations. But views then, I'll quickly go through. We've got about 7 minutes. Goldman Sachs, about a couple of weeks ago, they said, Blankfein said it's obviously a very, very high risk factor, and that consumers should be prepared for it when talking about a potential recession. But he did qualify those remarks. Noting that the Fed has extremely powerful tools and that a recession is not bait in the cake. Bank of America maintaining their forecast for core PC price index of 4% growth. Again, a key measure of inflation for the Federal Reserve, still above the Fed's target of 2%, and then seeing that drop down to about 3% rather than 2.6% in 2023. Moynihan, May 24th, said the consumers are doing well against inflation and increasing their spending, paying down debts. And Deutsche Bank also said that no indication yet of the Fed dissatisfied with tighter financial conditions, according to Deutsche Bank's Jim Reed. But nobody claimed it was easy to get inflation back. And so if you're looking for a Fed put, to be patient. So again, just reiterating that the Fed is in their tightening cycle and is very hawkish at the moment. And then JP Morgan, just reiterating that there are different bits of sentiment that are affecting the markets that are making it quite difficult to deal with how things are economically. Then you've also got the concern, so both those bits of sentiment of Russia, Ukraine, COVID lockdowns, and tightening monetary policy, in his view, is seen as news that could be a top story in any given year, but they've been combined together. So it makes it even difficult to kind of gauge where the markets are at the moment and what they're feeling. Fed's view, I think we'll kind of skip it a little bit, but just a reiteration of keeping rates, keep wanting to raise rates Then we have the current sentiment, so it's central bank tightening, as we've seen with the S&P 500 recently, seeing a depreciation, hikes being priced in. China rate cut last Friday. It gave a bit of a reprieve to the markets that China would support the economy during the COVID lockdowns that they had. And also, if we looked at the other areas too, so again, China looking to provide $21 billion to businesses as additional tax relief during the restrictions that they've imposed. So this is so if we're looking at the China, then that has an impact, and what could happen later on down the line for the markets. We'd seen that second slump in productivity and retail sales, which for the markets they didn't take too kindly to first of all China going into a lockdown for the second time, but when we did get to this point here with industrial production falling off, or industrial output falling off, then we had seen that sharp decline, not only in the economy, but also in the global economy, but also in the markets too for risk-on assets such as the S&P 500, and also bond yields had also declined too. But that's something just that I made up for you here, just so you can see that there. And that was the S&P after the bit of news. So we'd seen that reprieve. So it's up by 0.85%. Last Friday is what we'd seen there. So if we look at the last consumer spending report, then if we bring that up for you, so about 10 seconds before, about not too long before the release. Okay, so data was much better than expected for Canadian GDP month to month. Consumer spending comes out shortly. So already we've seen some movement towards the downside on the S&P 500, and that was with the employment costs that came out at the same time. That employment costs were picking up, and that leading to a high inflationary pressure from markets for the economy. So there we go. Kind of skip ahead. We've got about 3 minutes. There we go. So consumer spending came in much better than expected too, as did a majority. But PC price index was more mixed. But overall, the data what we've seen was positive there for consumer spending. So it led to an uptick on the dollar yen. And if we kind of skip ahead, and then S&P kind of continued to move towards the downside. Okay, so let's go to our deviations. Let's escape this. Bring that out of the way. We'll get got about less than a minute left with the release. Kind of bring it out back to so we can see here. So deviation wise, what we've seen last time, I'll quickly go through it here. But when data was much better than expected, we'd actually seen more of a movement in the bond market. We'd seen 25 ticks down, and on the S&P 500, that had seen a negative move towards the downside by about 43 ticks down, and it was about 10 minutes later, it was down by 50 ticks. The currencies, with dollar yen was the strongest reactor to that there. It was down. It was up by about 18.5 pips, and then up by 17 pips later on. But the stronger mover or more reaction was in the bond market and the indexes and the dollar yen. We got about less than a minute to go till the release, and let's bring that up here. So, okay, bring up tick strike. There we go. About 24 seconds left. For 10 seconds. Okay, so Bonds good trade balance. Personal income lower at 0.4%, lower than the forecast of 0.5. Waiting on the consumer spending data itself now. See what happens. The S&P, not really seeing much reaction so far. Yeah, we're waiting on the other bits of data. Okay, 0.9%, 0.9% higher than the forecast of 0.8% for consumer spending month on month. Real personal income or consumption also in line with expectations. So seeing the S&P 500 seeing a move towards the upside. Dollar yen seeing a move towards the upside too. There off of that data. If we're looking at the PC price index, core PC price index, slightly at 4.9, basically there's what we can see. Personal, more or less so, the rest of the data isn't outstanding, but seeing that consumer spending and inflation in the PC price index for the year on year being slightly better than expected, paired with the consumer spending also being slightly stronger than expected compared to the forecast. Did see them move towards the upside on the dollar yen. Also the S&P 500 too, as said, did see some movement there. Government bonds and bond prices did see some movement towards the downside there on the US 10-year bond price. Okay, gold, so I had seen some movement towards the downside too. So the bond market, okay, there we go. Actually, the dollar yen, seeing more so reaction here. We just quickly measure. Look. Okay, how many pips is that? About 14 pips there on the first candle, and if we kind of see where it is at the moment. About 21 pips or 22 pips that we'd seen on the dollar yen. The S&P 500 did see some positive reaction there. Whoops. Oh, should be back on now, hopefully. Gold, let's have a look at gold. So 830. Okay. So about not too much. Did see some movement towards the downside there. Bond prices, if I go to 830, so drop down around here. See. Okay. Let's see where it is so far. It's a little bit harder to kind of see. Okay, so the bond market, bond prices didn't react too favorably to that. Seeing on the S&P 500, I think one of the things to kind of consider is that, okay, with the prior figure as well, although it was better than expected with the data, and we had seen the dollar yen move towards the upside, did see that the prior figure was that the actual figure is much lower, was lower than the actual, lower than the prior figure. So that could be one reason as to why the S&P 500 did see some movement towards the upside. But also I think one thing we've also got to understand too is that with consumer spending, if we are still seeing the consumers are still quite strong in their spending pattern, and then they're not put off by inflation, that could also be another reason as to why the S&P 500 may have seen that movement towards the upside initially. And did see a bit more of a whipsaw reaction for the first two candles we see. Now it's moved to the upside. Bond price is still looking to reverse the earlier movement towards the downside. And gold taking a hit there. All right. So again, so the dollar, I think what we can see there, seeing that dollar yen seeing that nice reaction. I think let's also go to GBP USD. Yeah, okay. So not as clean as the dollar yen reaction that we had seen. A bit more choppy at the beginning on that first candle. Let's go the euro dollar. Euro dollar, okay. Similar to cable, a bit of choppy move at the beginning and then move towards the downside of the dollar yen, off of the dollar strengthening there. Okay. Right. One thing I do want to have a look at is the report too. What does that give us as well? Release highlights. Okay, so personal income primarily reflected an increase in compensation. Personal savings rate was 4.4% in April compared to 5% in March. What we've seen there. Okay. So less personal savings then in the US, so meaning that there's actually more spending going on these. I wonder if it's within services. That's what I want to know. If it's more on services, that's what we want to see. Consumer spending. So within services, the increase was widespread, led by food services and accommodation. And what else? So within goods also increased primarily for motor vehicles and parts. So these are for durable goods as well. We can see consumers are putting more of the money into the economy and their spending. Okay. Right. So motor vehicles and parts. So gasoline and other energy goods. Okay. So that's seen a decline. Of course, I think with high energy prices, that's going to be quite evident. Gasoline and energy prices. What else do we have? PC price index starting to show a bit of a slowdown as well. So I think, yeah, that's one thing we've also got to consider as well, is why the S&P 500 may have seen that move towards the upside too. Looking at the prior figures as well, that inflation is weaker than the prior figures. So for the year on year, I said it came in at 6.3% compared to the prior 6.6%. Core PC price index is also lower than the prior figure too. The thing that also helps that inflation in the Fed's view on their key measure or their key gauge of inflation is starting to slow down and isn't as strong as it has been in recently. So deviation wise, if we just quickly look here. So even though the data was really strong, we had seen that last time, the data with the core PC price index when there was a slight decline here. Overall, the other bits of data were stronger. So we did see that initial pop and then that reaction and then move towards the downside there on the S&P 500 from the better than expected data. But I think overall we've seen now that's the second month of inflation seeing a move towards the downside in the Fed's eyes, or a slowdown altogether, where you don't see huge we're not seeing an increase as such compared to the prior figures. All right. Okay, let's have a little look. Let's put that in here. All right. Okay. So that is the release there then for you. There isn't really anything else you can kind of garner from that there. Hope that kind of helped you out with what to kind of expect. Bearing in mind with the macro ace mailing list. So with the deviations that you see here, or that are shown you here, and that is shared with that data is shared with our people or subscribers to the mailing list. Okay, so you're able to get an understanding as to how the markets had reacted in the past to release and kind of prepare yourself for what to expect later on. So similarly is what we did see, the bonds did see a move towards the downside. Gold was more of a weird reaction last time round from that data. But I said bonds moved in the direction of the dollar yen, moved in the similar direction as we've seen last time. But the stocks, or the S&P 500, had seen the inverse reaction to what we had seen previously with the last couple of reports. But that is something that's available to our subscribers for the mailing list to be able to have a look at and to be able to go into a bit more detail of. And also a reminder, so Financial Juice, where we got the release. Okay, so if you were trading let's say if you were trading the dollar yen or some of the other currencies, then Financial Juice is the place to be. The reason being is that having a live voice and text service is something that investment banks use to manage their risk and also to capitalize on potential trading opportunities as well. When they hear a figure, they might buy or sell it. But that's why, but mainly a lot of traders, from what I've seen in the past, use it to manage their risk when it comes to looking. So, looking at economic releases or seeing headlines that come through, maybe from the earlier headline that we had before. Kind of just scrolling a little bit more. There we go. So one of the early headlines, one of the headlines we had here, with the EU leaning toward delaying the pipeline ban to get an embargo deal. What we've seen in the markets, if I just bring it back up on WTI or US oil. So that was around 545. Okay, the headline came out around here, and then what happened was we'd seen that move towards the downside on WTI crude oil off of the back of that headline. So if you're unsure as to why the markets might be moving in a certain way, then what a Squawk service does is it gives you that information that you might be missing or might not have seen as to why the markets move in a certain direction. So having a live voice and text service is quite essential to be able to, as said, manage your risk and to stay on top of things and what's going on in the markets. But also, one thing which is quite attractive, which makes Financial Juice Pro quite attractive, that with the light version of Financial Juice Pro, you get delays, whereas in the Pro version, there are no delays in voice or text or with the release-wise. And if it matches your trigger, then what it'll do is it'll show up with a little buy or sell sign here, depending on what your trigger is, if it meets your trigger. And then again, that's also real time as well. So as soon as the data comes out, instantly at the same time, that trigger appears for you there. Okay, I said if it matches the requirements. So you have and also with Financial Juice Pro, it's 24/5, right? So we're running 24 hours, 5 days a week that we run the service for you guys. And again, so we have an Asian session, US and European session, so covering all the bases basically, as much as we can, so that you guys get the best experience of what a Squawk service provides. So what we want to do for you is to provide you with a 7-day free trial of Financial Juice Pro. That's in the link there in the chat for you, that you can have a trial of. And also, if you're looking at TickStrike here as well, with TickStrike, you can see that that's currently going off at the moment. So when what TickStrike does, it measures the amount of order flow that there is flowing within a certain or different asset classes That goes from forex to futures and stocks, in bonds, in commodities, and also for stocks as well, and also ETFs and ETNs and crypto, right? So TickStrike has a variety of different areas that it covers when looking at order flow and how strong the momentum is within that asset or within the market overall, right? So imagine you're in the trading pits and you have the guys and gals standing there, and the market opens up, and they all start shouting buy, 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 sell, 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 buy, 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 and then they start shouting that out loud. So that shouting that you experience or see people doing, that's translated here into TickStrike, where it's converted into, it's showing you the amount of momentum that there is of buying and selling. So plus 14 showing you that there's buying going on, as we can see here with TickStrike here on the right hand side, correlating here with the S&P 500, and also with, if we're looking at gold too, so seeing some selling going on in gold there as well from TickStrike. But what you can do is you can level 1, if you can see that here, shows you it's at the most sensitive level, i.e. the more reactions, i.e. it will show you a lot more movement and a reaction from the markets compared to, or if there's little bits of momentum that are kicking off, then compared to if I put it on a higher level, 15 is the least sensitive. So only when there's a real movement or real momentum pushing the markets, then I can increase that up and then capitalize on that and see whether or not the momentum is really holding up. But so a lot of traders, what they do is they usually scalp trades with TickStrike is quite useful for that. Again, use it however you want to use it. Not really, again, so if you want to capitalize on the short term, small swings that are happening, then yeah, TickStrike is the way, is a tool that you can use to help you with that there. And then so there's also a 7-day free trial of TickStrike there too. So if you want to have a 7-day free trial and have a little play around with it, remember on the site there is TickStrike there, but that's set at a specific level, at level 6, and doesn't really let you look at the other assets. Just shows you the S&P, the Eurodollar, oil, and Bitcoin. Okay, but if you want to get go into more detail and see how other assets are faring, maybe the NQ we can see here, or the other bonds, how the 30-year bond is reacting, or the 10 and 2-year bonds futures, how they're reacting, then you're able to do that with the pro version, the full version of TickStrike. So that's the 7-day free trial that is available there for you. And also, if you like this video, don't forget to like, share, and also subscribe to the channel. And then also, if you want to get a replay of both the EIA inventories and the consumer spending report that we have done this week, and then sign up to the mailing list. Okay, on the Sunday is when I put out the week ahead view of what to expect, and also the deviations as well that you can see here. So again, you can get a bit more detail and analyze that data a bit with more time in your own time, rather than me trying to rush through it here to get through the video or the live stream before we get the release. So those are all the links there, and also don't forget to follow us on Twitter too. So MacroAce, there it is. You can click on that link there and give us a follow. Other than that, thank you very much for jumping on, and hopefully that did help you, and hopefully you did find that useful. I will see you, as I said, I'll be putting out the video for you, or the 2 videos that we had on today at the end of the day, and then Sunday I'll be posting out the week ahead with the deviations and the releases of what to expect. Other than that, thank you very much and goodbye.